Welcome back everyone to Moneycontrol live stream. You're watching Closing Bell and I'm Santosh Nair. Well, the bulls did fight back very strongly midway through the session, but at this point it's clearly the bears who are having the upper hand for now. And why exactly is the Indian market still losing ground when global markets overall seem to be in a perky mood? Well, that's the big question. Well, one of the reasons most likely could be that India has outperformed other global markets for much of 2022, and probably that is now prompting some of the international investors to cut their exposures to India a bit. Yesterday also you saw some heavy selling pressure by FIIs. They sold at the net level, they sold over 1000 crore worth of shares, and while domestic investors have been steady buyers, at this point the lack of buying support from FIIs, that somehow seems to be weighing on the market. The Nifty has fallen below the 18,100 mark while it's struggling to stay above that level. Clearly technical analysts are seeing this as some kind of a critical support, a psychological level probably, which could indicate which way the market is likely to move in the coming days. Now 18,200 was the first major support level. The index closed below that level yesterday, and now it's gone below the 18,100 mark also, while but at the same time it's been trying, the bulls have been trying to make a comeback there, pretty unsuccessful for the moment, but we still have close to about 25 minutes of trading still left for this session. And looking at the other major moves in the market today, autos, metals and PSU banks, these are the sectors mainly where there has been much selling pressure today. For the second day running, IT and pharma shares have done better than the rest of the market. However, those two stocks from those sectors too are in the red zone at this point in time. The India VIX is above 15, it's above the 15 mark, though it's down by 1.5%. Overall, that seems to indicate that maybe traders don't expect the downtrend to persist much. Typically what happens is whenever the outlook on the market is bearish, the India VIX tends to move up. Between 12 and 20, analysts tracking the VIX say that it's not cause for much concern, but the moment the VIX starts to gain above 20, that is when probably one should get cautious. And a quick check at the FNOQs. Bandhan Bank, Gujarat Gas and UPL, these are seen build up of short positions, while M&M Financial, Grasim, About India and PNB are seeing build up of long positions at this moment. And in stock specific moves, Mahindra and Mahindra, Tata Motors and L&T are among the prominent losers in the Nifty, down by about 2% each, while HDFC Life, SBI Life, they are the key gainers in the Nifty, among Nifty stocks, up by around 1% each. And with that, let's move on to the stocks on our watch list this afternoon, starting with TTK Prestige. The stock has been under pressure over the last couple of months, has been steadily falling, in fact down by close to about 20 odd percent, more than 20 odd percent in the last couple of months. One of the reasons for that is that the competitive intensity in the sector has risen sharply. We have been seeing quite a few M&A deals here. Now Whirlpool has bought Elica, Philips has bought Preeti, V-Guard has bought Sunflame, and Crompton has brought Gandhimati Butterfly. So we have seen a spate of acquisitions in the kitchen appliances segment, and according to ICICI Securities, this will push up the competitive intensity because it means that there will be more investments in expanding the distribution and also innovations. But at the same time, this could also lead to a faster shift from the unorganized sector to the organized sector, and that is something which will benefit a company like TTK Prestige, because its brand, which is the Prestige brand of pressure cookers, is about 50 years old now. So clearly because of its strong brand recall, TTK stands to benefit from this trend of shifting of market share from the unorganized to the organized sector. ICICI Securities is bullish on TTK Prestige, and it sees the revenues and net profit growing at a compounded rate of 11.9% and 9% over the next couple of years, and it has said that new product launches, volume growth and also increasing market shares and innovation, this should be the key factors which should help the TTK Prestige stock climb higher in the coming months. Next stock on our watch list is UTI AMC. Now, the stock rallied sharply the day before, mainly on reports that Tata AMC probably was going to buy out the stake of other leading PSU banks which hold stake in UTI AMC at this point in time. However, after that there has been no confirmation of the deal so far. So, how does one play the stock at this point, and that is something Moneycontrol Pro analysts will answer for you. Now, the things in favor of UTI AMC is that besides being among one of the leading players in the asset management industry, it's also got a strong presence in the beyond 30 cities. Now, the beyond 30 cities account for almost 23% of UTI AMC's assets under management. Now, that is one segment which is still underpenetrated because awareness is fairly low, which means that UTI AMC is in a better position whenever the growth starts picking up in a big way. Now, one of the factors which go against UTI AMC is that its equity assets, they are about 31% of the overall assets. Now, that is a negative because it is the equity assets which yield which give better yields, and lower equity assets also means that the markets tend to value that stock at a slightly lower level compared to the other AMC stocks which have a higher percentage of equity assets under management. But that said, besides the 2.33 trillion which UTI manages under its mutual fund assets, it also manages the EPFO funds, retirement solution, PMS and AIF solutions. So, when you put all that together, UTI AMC is managing close to about 14 trillion rupees, which is fairly sizable. And according to Moneycontrol Pro analyst Neha Dave, at this point valuations are just about okay. You can't say that the stock is really cheap. Its market cap is about 4.6% of its total assets under management, which is pretty much in line with industry standards at this point. Moving on to our next stock, it's Page Industries. This stock too has taken a bit of a beating over the last 2-3 months. It's been down by close to about 20%. Now, the company's management was on the CNBC TV 18 channel today, and what they have said is that overall the consumer retail space appears to be quite challenging at this point, and that the company cannot be immune from such a trend. The management also said that overall the third quarter has been a slightly softer than usual, but they are expecting things to improve in the fourth quarter. The company has also said that overall the prices of cotton has remained stable and are likely to may remain that way. That is because the crop has been pretty good, but at the same time, even if cotton prices do rise, the company has said that it will not be hiking prices. So, this clearly means that the company does not have pricing power at this point in time, which could be one of the reasons why the market has taken a slightly negative view on the stock, and that explains why the stock is down by close to about 20% over the last couple of months. The last stock on a watch list is Specialty Restaurants. Now, the company has raised 127 crore rupees through a clutch of investors, and on conversion of the warrants, these investors will hold about 11.3% in the company. Again, the company's management was on the channel. It has said that the funds will be used for expanding the company's presence both locally as well as globally. And besides that, the company's first quarter performance has been fairly good. In fact, revenues have crossed the pre-COVID levels, and this despite the fact that the company had fewer dine-in restaurants. It had about 83 dine-in restaurants compared to about 109 dine-in restaurants pre-COVID. What the company has done is it's rationalized its number of restaurants and also stepped up delivery services. That is where it's been able to make money. Besides that, it's also been able to make more money per restaurant, and the company had also gone in for a lot of cost saving measures which seem to be paying off well at this point in time. And for the restaurant industry in general, the second quarter is always better than the second half of the year is usually better than the first half. Typically revenues tend to be about 25% higher. That apart, the company's margins are also expected to get better. The company clocked about 21% margin in the second quarter, which is a fairly good number compared to what it was about a year back. And given that inflation is easing, maybe the company's revenues, maybe the company's operating margin could further strengthen from these levels. The company is also entering new cities to scale up its sweet business, which it offers under the name of Sweet Bengal. Well, and before we wrap up this edition, a quick take on the markets at this point in time. Mid-cap stocks continue to be under pressure. Nifty Bank is also one of the big losers, down 171 points. It's been a very volatile session for Nifty Bank. It managed to make a good comeback and was briefly trading in the green, but since then has once again given up a lot of gains. PSU banks are seeing a lot of selling pressure, and so are private sector banks, most of them in fact, and these are the stocks which have had a good run up over the last couple of months, so some bit of profit taking only to be expected. Tata Motors continues to be under pressure, down by about 2% at this point. And well, with that, it's a wrap on this edition of Closing Bell. Thank you for watching. We'll be back again at 9 a.m. tomorrow.